Sam, great to have you here. So many things moving around and trying to, assimilate in this market. Obviously, you have a pretty weak start to the year, 2 months with significant monthly declines, January and February. We've got the typical dynamics of how a market absorbs a 10% correction or more. And then, of course, you have the way markets tend to behave around military conflict, geopolitical stress. As you put all that together, what are your main observations about where we might go from here?
Well, I think if you look first off to history tells us that we have normally seen market declines in the first quarter of years following gains of 20% or more, and that in all of those 20 observations, we ended up getting back to break even before the year was out. However, this is the sophomore slump year of President Biden, and typically volatility is 40% higher in that second year than the other 3 years of the 4-year presidential cycle. Add in the current events that we're seeing right now, history typically says you are better off buying than bailing when it comes to military conflicts. But of course, there are exceptions. Look back to 1956 with the Suez Crisis and the Russians rolling into Hungary to crush the Hungarian uprising, and we end up with a deeper decline that takes longer to recover.
Sam, since we're going back through history, one of those years that gets mentioned a lot when we're talking about downside risk to the market outside of a recession is in the early 60s. It's 1962. You had one of these years where the economy was still expanding. Of course, at the end of that year, toward the end, you had the Cuban Missile Crisis. Is anything similar to the setup here? Because I've heard that one invoked.
Oh, absolutely. First off, you have a first-term Democratic president in their second year in office. You have inflation be a major concern because really the reason that we slipped into a bear market in 62 was that President Kennedy really pushed back on U.S. steel from raising steel prices and therefore beginning to fan the flames of inflation. Also, you then had the military tensions that culminated with the Cuban Missile Crisis. So in many ways, it's similar, not exact, but I think certainly similar.
So you say there's an opportunity in certain stocks, especially ones that provide income in the form of dividends. Tell us how you would be looking for that.
Sure. Hi, Sarah. Well, first off, I think income investors should be thinking like landlords, not like traders. You don't want to be pricing your unit on an hourly, daily, or weekly basis. Look for those companies that pay a nice dividend yield, but also are consistent in terms of paying those dividends and have no problem with those dividends going up every year. So I did a screen on our MarketScope Advisor platform looking for those companies that have buy or strong buy recommendations that are paying a dividend yield of about 3.5 or more, and have an S&P quality ranking of B+ or better, and came up with several non-master limited partners, such as names like Amgen, believe it or not, biotech area, Blackstone, ConAgra, Omnicom Group, Philip Morris. So quite a few names that are attractively yielding for investors who want to buy for the longer term.